Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Joining me again is John Nersesian. He is the advisor's professor. Literally, he is the advisor's professor. I am so honored that he has joined us in our podcast studio today. John teaches professionals like me in the advanced education, advanced wealth management strategies. And we're going to be talking about that today. A lot of that, a lot of ideas. For those of you who may not have listened to our previous podcast, I got to tell you, shut this one off and go to that one. In that podcast, John and I talked about the tricks that our brains play on us and have us do things that really sabotage the outcomes that we're looking to achieve. And most of the time, we don't even realize that that's happening. It's fascinating. John's done a lot of work in that area, in a lot of areas. He is, wait till you hear him again today. He's brilliant, absolutely brilliant. He teaches at the University of Chicago and Yale in a program called the Certified Private Wealth Advisor Program, CPWA certification program. This is for advanced planning strategies. Those of us who have kind of been in the industry for a while, we think we might know a lot, but there's still always a lot more that we need to know. And so I was talking with John about the podcast today, and one thing led to another, and he started talking about the program. I'm like, John, I got to take that. That sounds phenomenal, because it's so important for us to stay ahead, right? To understand the tactics and strategies that, can be useful in the lives of the people that we serve. So, John, welcome back. Thank you so much for joining us again.
Oh, it's my pleasure. That's what makes you such a great advisor, the fact that you know a lot, obviously, and are so helpful to your clients, but you're always looking to learn more. And I think that desire to learn and to be more helpful to other people is an admirable quality.
I think the longer I do this, the more I realize the less I know.
Yeah, I feel the same way.
Right? It just is amazing, all of the things. And just in the conversations that I've had with you over the past few weeks, it's like, wow, it is a humbling industry, that is for sure.
But doesn't that make it fun? I mean, if we knew the answers to every endeavor, to every conversation that we were having, if it was the same thing over and over again. Did you ever see the movie with Andy McDowell and Bill Murray, Groundhog Day, I think it was called? The guy wakes up and every day is the same day. It's a pretty boring existence. Yeah. The fact that our industry is evolving, the fact that there are more skills for us to develop and to share with others, I think that's what makes it challenging and fun.
It is fun. And I also find, at least for me, that, for example, in my quarterly letters, I have written a letter to our clients every 90 days for over 30 years.
Wow.
And it's interesting when I go to think about what I want to write about. Mm-hmm. I usually write about stuff that I don't know.
Good.
For example, the Russian-Ukrainian conflict, right? And I guess I never realized where it all came from. Like, what could it have been to make this person, Vladimir Putin, invade another country? Like, what's the history behind that? So, Walt Whitman once said, if you don't know something, write a book about it.
Yeah, there you go.
In my case, I write a letter about it.
Yeah, I love it.
So it's, and I will also tell you that I also, thankfully, with this podcast program, I think that's one of the best, benefits, the greatest benefits of this podcast program. For those of you who are advisors out there, and I know that there are a lot of you who are listening and tune into these programs, for me at least, and for my firm, what I found is that the podcast per se, yes, it's great to share this information with clients and with the public, but it's also really important for my team. Mm-hmm. I was just telling them this morning, I didn't plan on sharing this, but I'm renaming this team, and these guys are all my key mates. Oh. It's Key Financial. They're my key mates, right? Because we are key to each other, right?
And to your clients.
And to our clients, absolutely. And so what's interesting is that the podcast program has become another avenue for us to learn. Mm-hmm. For example, when, COVID happened, We talked a lot about COVID. I do have a medical background, as you might know. I used to be an ICU nurse, but I didn't know the difference, for example, between a virus and a bacteria.
Right.
What is the difference?
Right. Medically.
Well, yeah, exactly. So, and is that relevant to a person's money? Not really, but maybe a little indirectly. And it helped us to make better decisions during that period of time.
I love it. Just the fact that you wanted to learn about it, I think, is really the key concept in this discussion. So stop and think about this. What we do for a living is we teach people, right? We impart advice. We teach them. I teach advisors. You teach the investors that trust you with their capital. But in order to be a good teacher, the first thing you have to be is a good student.
Yes.
We have to learn first. So we acquire the knowledge and the competencies required so that we can then share them with others. And that desire to learn, that's, I think, what gets you and I up each and every morning.
Okay, John. So right now, you and I'm going to learn more from
Maybe.
that brilliance of
Maybe.
yours about the tax laws.
Okay.
Okay.
Sure.
So let's kind of rewind to last year.
Yeah.
You and I were frantically working at the end of last year to get ahead of what was potentially a pretty draconian new tax law.
Yeah.
Why do you think that didn't pass?
Well, nothing happened. I mean, that was kind of the biggest surprise. If you and I were betting last year, and I think you and I would not have been alone, by the way, I think a lot of folks were assuming or counting on some sort of major tax reform coming. Stop and think about the evolution, right? It started with Biden during his campaign, talking about tax reform, about making it fairer, more balanced. It then evolved into the Green Book publication back in April, and we saw things about, capital gain rates going to ordinary for people over $1 million, and maybe the loss of step-up in basis, and then even the submission to House Ways and Means in November. I think all three stages along the way, you and I were convinced that tax reform was coming. Now, the advice I gave people back then was, wait a minute, I get it. We're concerned about this. It has major implications for our financial decisions. But first things first, learn about what's being discussed. Go ahead and plan for potential changes, but pause before you do anything. Because we had a suspicion that, it may not evolve. It may not actually come to pass. A lot of what we were dealing with were the results of TCJA back in 2017, the lowering of ordinary rates from 39.6 to 37, the idea that capital gains were stuck at 20, plus your 3.8% NII, the increase in the estate tax exemption amount. The good news is you gave great counsel to your clients. You said, let's learn about this, let's prepare for it, but let's not do anything retroactively until we really understand what's going to pass. And of course, nothing did.
It's so interesting because that retroactive, that word, boy, did that stop a lot of people dead in their tracks.
Yeah.
The fact that they were looking at, making capital gains rates, the higher capital gain rate retroactive to, I guess it was September.
Yep.
Well, what are we going to do now?
Right.
It's October. It's too late for us to do anything.
Can't do anything about it.
And it's interesting because I will tell you, and I admit, I went out and bought a software program that would run an analysis of, does it make sense to go ahead and sell some of these assets, go ahead and pay the capital gains tax at the theoretically lower rate to avoid ordinary income rates later on.
I hope you kept the receipt so you can take that back to the store.
Really. I learned something, though. We
What'd you
ran
learn?
the numbers, and it really came down to time.
Yeah.
It came down to what your holding period is. That's all that matters. And just as we talked about before, it is very personal because, yes, some people might be paying that 20% plus the 3.8% today, but maybe they're not going to be in that bracket 10 years from today when they retire. So why would we sell something when they're not going to be subject to it anyway?
Right.
So it was very personal. And it's so interesting because at the end of the day, it makes me realize how important having good judgment just exercising good judgment that's looking out for the best interests of that family based on the information that we have today, which can change in a moment's notice.
I love it. I love it. Taxes are an important part of that process that you bring to your clients, of course, this comprehensive wealth management program, looking at obviously, what's important to you in your life, your financial security, your retirement resources, your ability to educate your kids, to send them to Georgetown or Lehigh, and all the important things we do. Taxes are a part of that equation. Now, I know that some advisors are somewhat reluctant to talk about taxes. Hold on, John. I'm not a CPA. I'm not a tax attorney. I don't want to get myself into trouble by talking about taxes. I'm opening up some liability issues here. Well, I have 3 rhetorical questions to ask. Do you provide advice to your clients on the recognition of gains and losses? Of course we do. Do you provide advice to your clients on their charitable giving, what they give, whom they give to, and how much and when? Do you provide advice to your clients on retirement accounts, contributions to their retirement accounts or distributions? You can tell from my simplistic examples, so much of what we do on a day-to-day basis has a tax impact on the outcomes our clients achieve, that we have to be tax aware. We have to include a tax understanding in the financial planning work that we do for clients more broadly.
Absolutely. I have no problem whatsoever talking about taxes.
Good.
In fact, every year we get every client's tax return after the fact and we review it.
Oh, I love it.
Because I think what I've learned over time is that every once in a while we catch mistakes and they're human errors.
Yeah.
No big deal. Just, file an amended return or whatever. We find opportunities that we didn't know were going to exist in this calendar year. And to me, that's the whole idea, is to be proactive.
I was just going to use the word proactive.
Yeah.
Because the common refrain I hear from many investors is, well, wait a minute, Patti. My CPA is taking care of that. They're going to file my tax return in April, and they're going to make sure I get all the deductions I'm entitled to and lower my tax bill through the filing process. Well, hold on a second. Next April, it's too late to do anything.
Right.
This is retroactive accounting that's looking backward as to what already occurred. It's not the proactive planning that you're speaking of. And I think that is so valuable, to have conversations with families today about the steps they can take. Not that the tax outcome is necessarily the most important objective. It is a component of the financial planning process. And being on top of it, being aware of it, taking advantage of the unique opportunities that are before you, I think is important. Think about this. We try our best to allocate capital. Should I overweight international stocks versus domestic stocks? Should I overweight small cap versus large cap? And we try our best to try to allocate capital in the most productive fashion. But the truth is we can't control it. Taxes are something that we can control. We know what the rules are. We know that when we contribute to an HSA, that money comes out tax-free. We know that when we put money in 529 plans, that we're able to save money for college in a tax-efficient manner. So there are knowns within the tax code that allow the investor to enjoy more probable benefits than are maybe accompanying or available through traditional investment advice.
It sure is the case. And also to understand the unintended consequences of certain actions. Yeah. For example, we talked about this before. We run the numbers. We're not going to guess. We're running the numbers. Okay. They are projections, cash flow, income tax, etc. And especially as a person is approaching or in retirement, a lot of times they'll go from a very high tax bracket and it plummets. And all of a sudden they go from 37%. And if we've done our job right, hopefully, in the 3 years before retirement, their tax bracket's going to go down to 12%, right? So here's a tactical idea for everybody listening. If that happens, what can you do at a 12% tax bracket?
Roth conversions.
Roth conversions. Love it. Take just enough of a Roth conversion to get you up to the tippy top of the 12% tax bracket.
Right.
However, be careful, because a lot of people who retire early may be on the ACA, right? That's also known as Obamacare. And by the way, if you're in a 12% tax bracket, you're probably getting a juicy subsidy. Now that subsidy is something that you don't want to have to give back. Right. So as we think about the tax planning, and these are great ideas, Roth conversions are, for many people, a home run. Got to be careful that we're not creating an unintended consequence where somebody's going to lose that $1,000 a month.
It's great that you've identified that, because sometimes we make these decisions on the surface. Oh, I'm going to go ahead and do this conversion or accelerate income or whatever the strategy might be. But the tax code has ripple effects throughout it. And so that decision to either lower my taxable income or increase my taxable income may have ramifications that are not immediately available, items that occur kind of below the surface, so to speak.
Yeah, exactly. And even from an investment perspective, for those people that you may be talking to, they're managing an investment portfolio. If they know that the client's going to be in a 12% tax bracket, for example, if that's me, if it's November or December and they've got a big capital gain, and I know they're going to be in a 12% tax bracket next year, well, I think I'm going to procrastinate a little bit, because we don't know what's going to happen with markets.
Nope.
So why not sell that asset or the portion of it January 2nd.
Yep.
And guess what? They don't pay any tax on it up to a certain amount.
My son just graduated from Northwestern. He works up in Chicago for the Chicago White Sox, and he graduated in June of last year. And so he started his working career, and of course, being a relatively new employee, his income wasn't very high. He only had 6 months of earnings. And so my wife and I, of course, wanted to buy him a graduation gift. We decided to buy him a little Audi Q3. And we thought about liquidating assets, right? And then using the money to buy this new car. But we took the advice that you just provided. Wait a minute. Our son is in a low bracket, in fact, a zero capital gain bracket. And so we can transfer that low basis property from us to him, have him sell it with zero taxes, acquired the same car, made the same gift that we wanted to make, but did so in a tax-efficient manner. These are the opportunities that so many people miss, but that they can receive benefit from if they work with great people like you.
That's a great idea. That's called income shifting.
There you go.
It's a great idea. You know, you and I talk with a lot of people, during the year. Very wealthy people do things like family limited partnerships to create that same kind of income shift. So, okay, so let's go back.
Yep.
Okay, the tax law, the Build Back Better plan did not go through.
Did not.
I'm curious, what do you think was the headwind? Is it because that with a change in any tax law, it's complicated, and those complicated laws have to be enforced, and enforcement costs money? Was that the headwind, do you think?
I think that was probably part of it, right? So you've got to get everybody on board. And you have a very divided Congress, of course, right? Relatively equal, and you've got one side of the aisle that wants tax reform and the other side that's opposing it. You have, of course, the Tax Cut and Jobs Act tax cuts that were implemented 4 or 5 years ago. And there are certain constituencies that want to maintain that, don't want to reverse those benefits for those high-income earners. I think you're absolutely correct, Patty. That was certainly part of it. I think part of it was just simply a loss of momentum and an appetite, given all the other issues that were on the table. This ballooning Federal Reserve balance sheet. $9 trillion. And how do we unwind that? There were other issues that I think gained more attention, so the tax reform really became subordinated in that political process.
All right, so let's talk about what they announced this weekend.
Yeah.
How about that? Was that unbelievable? Sure enough, we think we can breathe a little bit, and then an announcement comes this weekend with a tax. Now, most of the people who are listening to this are not going to be affected by this, proposed regulation. But
Right.
what scares me, John, is the potential down the road if they pass it and are effective in that enforcement.
Yeah.
Why don't you tell our listeners what it was all about?
So listen, before we get into it, and I'm happy to do so, Patty, let me preface my remarks by suggesting to you, I think there's a very low probability that this sees the light of day. I think it's likely to die on the vine, just like the loss of step-up in basis that was earlier proposed, just like the increase in capital gains from 20% to ordinary rates for families over $1 million. Those were relatively controversial. Those were big-ticket items, and they all wound up dying on the vine. I think this is likely to see the same kind of outcome or fate. It's the idea that families at $100 million would wind up paying taxes on unrealized capital gains. Now, your listeners know, of course, that we pay capital gain taxes on assets that have been sold, gains that have been realized in the tax reporting system. This is the idea of maybe preventing or taxing dynastic wealth that is created by me that is maybe going to pass on to my children that might escape the income tax system. This is an idea to try to capture some revenue from it. I think the number was something like $350 billion that it would raise, which is a relatively small drop in the bucket. But the enforcement of it, the concept of it, it's confiscatory. I don't mean to be too negative on this, because I do think we need tax reform to make the system fairer, to provide benefits for those who are maybe less fortunate. I'm 100% on board with that. I'm just not sure this is the right way to get there.
Yeah, it would be really hard to prove it, I would think. How do you prove that, the value of someone's business that might have been worth $50 million one year is now $150 million? Like, how is the IRS going to know about that and therefore prove it?
Yeah.
That's where I get lost, the enforcement of it. It's just, and, Even business valuation itself is difficult. One person, I could say that my business is worth $50 million. And if you were looking to buy a business like mine, you'd be laughing your head off, right? You got to be kidding me.
Exactly.
Right? So how do you value stuff like that? It's just
discounted cash flows. I mean, what's the interest rate I'm going to use to determine the net present value of that business today? Do I use comparable sales? Do I look at asset value? It's a whole can of worms. The other problem I think that you and I would have with it too, Patti, is once again, I think we're okay with this idea of producing additional revenue. Look, COVID was expensive. I mean, all the support that was provided, all the fiscal and monetary steps that were taken along the way. I get it. We're going to have to pay the bill for that period that we endured. So we've got to find a way to raise revenue, but let's do so in a way that's logical and easily enforceable, as opposed to some of these other ideas that I think are rather problematic.
Okay, so I'm going to throw 3 ideas at you.
Uh-oh.
Okay? And I want you to tell me which of these 3 do you think is most likely, which would be least likely.
All right.
I'm just curious what you might think.
Now, this is just a layman's interpretation.
Layman's.
I'm not representing any sort of tax
But
advocacy
boy,
group.
I'll tell you what, you're one of a kind. So, okay, so here's one. Let's just raise the rates. Right? That produces a ton of revenue.
Ordinary rates?
Simple, easy. Go from 37 to 39, and you just increase the brackets.
All right. So ordinary rates is one. Yeah. What's 2?
Option 2, door number 2, John, is raising the capital gains rate.
Thank you, Monty Hall.
Okay.
Capital gain
boy.
rates.
Oh boy. I'd rather be Vanna White.
Okay.
Come on.
Yes, I was dating myself with that reference.
Okay, there you go.
Yeah.
Monty Hall. Wow.
Yeah, do you
Even
remember
I
that show?
remember. I
Yeah.
sure do.
Yeah.
I sure do. Okay, so that's option 2, door number 2. Door number 3 is taking away the step up in cost basis at death.
All right.
Which is another very big deal.
Yeah.
Right?
So, okay, I'll give you my, off the cuff remarks as to, which of these are likely or unlikely or, feasible or not. I think the loss of step up in basis would be rather controversial politically, right? Because stop and think about this. You own a closely held business or you own a farm. You don't get the step up in basis at death, and that means that the heirs maybe have to liquidate an asset just to pay the capital gain on it. That was part of a proposal earlier on that the Biden administration had floated, and it met a relatively quick demise. So I would give that maybe the least likely or the most challenging opportunity for passage. I think raising the ordinary rates. Let's examine this concept of raising rates. What were the rates before TCJA at the max?
39.6.
We're at 37 today.
Right.
So bringing them back to 39.6 isn't really raising them, it's restoring them.
Oh, that's a good way to put it.
Yeah,
I mean,
I think
if
so.
you're a politician,
Maybe
right?
I should be.
Yeah, there you go.
So we raised the rates back to 39.6. I think that could be acceptable to many.
Okay, so let me stop you there.
All right.
Isn't that what the sunset provision's going to be doing?
It is automatically at the end of, I think, 2025, right? So a lot of the things that we're benefiting from today, that lower ordinary income rate, the capital gains rate, you got the NII, you got the estate tax exemption, a lot of this will automatically be undone or revert back to prior policy at the end of 2025 or the beginning of 2026. So what is that, about 3 years from now?
Right. Right.
So
yeah, that should be interesting.
Yeah, I think the current administration, though, wants to accelerate the process, given, once again, that unforeseen expenditure and this big deficit that we're running now because of all the outlays due to COVID relief.
When I think about changes in tax law, and if I'm a politician, okay, I'm thinking 3 things: votes, revenue, and votes.
Okay.
Right? That's why you pass tax law changes.
Yeah.
So here we are coming up to the midterms.
Yeah.
What do you think about the possibility for tax law changes given those votes, revenue, votes?
Okay. So when it comes to votes and politicians, okay, I get it. Politicians are going to have a difficult time winning any election when they talk about increasing my tax bill. What they often counsel is the idea of increasing your tax bill.
Oh, that's interesting.
Let's go after the wealthy, right? And I think 90% of the American population is in favor of that. Let's go after those with the significant wealth or the significant incomes. They're not paying their fair share. Let's find the additional revenue there. Because I think we all realize that the system itself needs reform, that the government needs the revenue. The question is, where do you get it and how do you get it? And so the idea is to, once again, go after the wealthy. I'm okay with raising tax rates as long as it affects him, not me.
Right. You know, it's so interesting that you bring that up in terms of what the politicians and how they're communicating it.
Yeah.
And during COVID, in one of my quarterly letters, I wrote about everything that the federal government was doing, from the fiscal stimulus as well as what the Federal Reserve was doing.
Sure.
And I kind of gave everybody that warning to say, just so that you know, this isn't going to be free.
Yeah.
And, we should expect that our taxes are probably going to go up.
Yeah.
And in the letter, I said this, and I do mean this, the way that money kind of worked its way through our population, was it perfect? No, there's never going to be anything perfect. But boy, it was sure effective, wasn't it?
We had to react to the situation at the time. Nobody saw it coming. Nobody planned for it. Nobody wanted it. But the reality is, well, wait a minute. The government was forcing small business owners to shut their doors, causing them significant financial hardship. And so we needed to step in and provide relief, support. And I think you and I as individuals, we're all for that. And so I think we did what we needed to do, given the circumstances at the time. Now we've got to figure out how we wind up paying for it, how we wind up resolving this big bill that we wound up footing back then.
And really, taxes, again, we rely on our politicians, which, unfortunately, sometimes it works and sometimes it doesn't. But, I think about what a government does with their tax revenues.
Yeah.
What is the purpose of the government? and then I think about the poor people in Ukraine, right?
Yeah.
You think about their government and what they're not able to do, right? And to think that they're looking at the United States for that kind of help. And it makes me feel, again, kind of okay to pay these taxes.
I love that perspective. Stop and think about the hardships that they're all enduring, and the idea that you and I would pay a few more dollars in taxes to try to resolve this humanitarian crisis, I think is just an interesting thought. In fact, I think you saw recent studies here about those. I think it was over 60% of Americans said, I'm willing to endure higher gasoline taxes by providing sanctions on Russia if it meant that I'm going to be providing some sort of support to those people in Ukraine. And so we're willing to pay a cost for what we believe in fundamentally. I'd like to think that as Americans, we're okay in here. We're good people, right? We want good things for other people. It's not just about our own success and our own wealth. There is an empathetic side to us.
Absolutely. And so at the same point, you and I being the benevolent people that we are, we also have to be practical, right?
Yep.
And I feel like my role in a client's life is to make sure that they're not paying more than their fair share.
Sure.
Because at the end of the day, just as we talked about in the prior podcast, it's about helping them achieve the outcomes that are important to them.
Yep.
And taxes are definitely a headwind for many people.
No doubt.
So to me, it's about understanding what the rules are,
Right.
black and white,
Yep.
maybe a little gray from time to
Sometimes,
time,
yeah.
right? But the gray stuff is just that we don't know how the IRS would rule on it,
Sure.
right? So we understand what the rules are, and then we apply the techniques that can reduce our clients' tax liabilities as
Right.
much as possible, right?
Where it makes sense to do so.
Exactly. So let's talk about that for a moment.
Okay.
And think about, you teach these courses at Yale and University of Chicago and just, wealth managers all throughout the country.
Yeah.
What are you telling all of us in 2022?
Okay.
What are your best ideas?
Oof, you got a couple of hours?
Yeah. Oh, if it's a couple hours, I'm all yours, John. Totally.
We'll do a couple hours another time, but let's go over a couple of them that may be relevant for the majority of the folks dialing in today. So number one, asset location. And I mention that because I noticed that many individual investors kind of miss this one. They pay a lot of attention to asset allocation. How should my dollars be apportioned across different asset classes to provide the risk and return I seek? But what about asset location? Certain investments produce capital gains, others produce ordinary income, some produce income streams that are tax-free. What goes in what bucket? And so a great advisory firm like yours works with clients to not only allocate assets correctly, but to think about asset location to minimize the taxes, to provide the most tax-aware, tax-sensitive outcomes for the investing that we're doing. There's a second idea, and this one's huge. I just finished writing a paper on this over the weekend. Charitable giving. It's not to convince clients to give away more money. $470 billion was given away last year, according to Giving USA Foundation. Our clients are giving money to charity, but in many instances, they're not giving correctly. They're going to some black tie affair, and at the end of the night, after their second cocktail, they're writing a check. And while I appreciate their generosity, writing a check, it may not be the most effective way for them to facilitate their giving. I'm a big believer in intentional philanthropy, not reactive, to actually have a plan. What do I want to give to? How much do I want to give? In what forms will I want to give? And then with the great help of an advisory team like yours, to think about which assets I give and when I make those gifts. Think about this without getting too wonky. The standard deduction is $25,900 MFJ. All right, on the itemized size, Schedule A, I get $10,000 for salt taxes. So the next $15,000 of charitable giving, where I write a check to charity, appreciate the generosity. I love it. I'm all in favor of it. But it's not providing a tax benefit. And so what we advocate for many people is the idea of bunching their giving, using a donor-advised fund. To put if I'm going to write $10,000 a year to the Armenian Church, maybe I put $200,000 into a donor-advised fund today to fund this giving over the next 20 years, and it's not cash. It's appreciated property.
Oh, beautiful.
So I avoid the capital gain on it. So it's that kind of thinking, not giving away more money, but being more tax aware in the giving we're doing, that can help the investor achieve a better outcome and provide even greater benefit to the charities that we want to support.
It's true. And some of the charitable trusts that we looked at last year, especially when interest rates were so low.
Yeah.
Wow.
Yeah.
Talk about
AFR
home
rates.
runs.
Yeah.
Oh, my goodness. You know, the charitable lead trusts were beautiful. Talk about win, win, win.
Sure.
Everybody won with that kind of planning. And it was very effective. It helped the charity. It helped from a tax perspective, and eventually, depending on the term that we chose, et cetera, the family ended up getting the residual value that was left in the trust.
I love it.
So it's a great wealth transfer tool on top of it.
Yeah, right. So it can provide not only the benefit of giving today or reducing my tax bill today, but there's a third benefit that you accurately identified. It can also help to facilitate efficient wealth transfer, as well as we think a little bit later on in the process. Hey, you want to talk about that a little bit, wealth transfer?
Love it.
Because we've been talking about income taxes.
Yeah, let's do it.
There's a big tax that some of our clients may wind up seeing down the road. It's the estate tax.
You bet.
Not income, not capital gain. It's estate taxes. Now, I know that a lot of people are saying, oh, I have nothing to worry about, John and Patti. $12 million exemption. When I started in 1981, the number was 600,000.
Right.
It's 12 million today. That's 24 per couple. I have three questions to ask that client. Number one is, when do you plan on dying? Number two, how much will you have at the time of your death? And number three, what will the number be in the year of your demise? And of course, we can't predict any of those things. And so it really suggests that people should have a conversation with their advisors about, where do you want your money to go? What's important to you? And what steps can we take to facilitate the efficient transfer of these assets to the entities or the people that you want to receive them?
It's so true. And there are so many different ways to do that. Some more painful than others, right? And there's a lot of things to think about. To your point, it's not necessarily whether or not you have a taxable estate today. That's probably not relevant. The question's going to be, what's it going to be in 20 years from now?
Right.
Or even longer when the second person, if you're married, passes away. And then what can you do today to reduce that exposure? And there are lots of things that people can do that don't have to be necessarily painful.
Right.
Do you want to talk about a couple of those? We could talk about slats. We could talk about annual gifting.
Yeah, well, let's talk about some of the basics first, because sometimes some of the best solutions, or at least where we should start, is with the more fundamental opportunities, right? Like when we talked about charitable giving, I can look at CRTs, I can look at CLTs, I can look at private foundations, but maybe for many people, hey, let's start first with a donor-advised fund to derive the benefits of bunching my deductions and tax-free growth inside the account and the opportunity to give appreciated property and avoid the capital gain. Let's start there, and then if a more sophisticated or complex solution is required, we can move on from there. Let's do the same with estate planning. You know, the obvious one that everybody misses, annual gifting. I mean, I think the number went from $15,000 to $16,000, and so John and his wife Lucine can give $32,000 and can give it to Margot and to Daniel, and can give it to their spouses if and when they get married. Keep your fingers crossed for me. And then grandkids, keep both fingers crossed for me. This is a very effective way for families to not only reduce their estate tax bill, both the current value plus the appreciation on it, but also to see the benefit and the joy associated with giving while they're alive. I mean, I think that's a pretty cool way to start the process.
And there's another kind of unintended benefit that a lot of families get from it, and that is, how are the kids going to deal with that?
Well, I like
right?
this idea.
Because it's very interesting when you start that gifting. Are they going out and putting it towards a nice car? Are they doing it, or are they funding their child's 529 plan? That says volumes, because that then helps me as the advisor to say, you know what? Maybe you want to consider doing a trust in your will so that the kids get a little bit at a time. Yeah. Maybe, 5% when they're 30 and another 10% when they're 35. That way they can't blow it all at once.
Love it.
And they become used to this idea of, having the assets, having the money, and what to do with it.
Love it.
Because if they get it all at once, it's like, it's like the sudden money issue, people who win the lottery, right? I had a client early in my career who won the lottery. I got to tell you, I was shocked at how quickly they went through that money. It was a lot of money.
We see it with professional athletes. We see it with lottery winners. We see it with people who wind up with a sudden windfall. Susan Bradley, that Sudden Money Institute.
Yeah, absolutely.
She does some really good work on that subject.
Phenomenal work. I've learned a lot from Susan in terms of how to guide people. I didn't have Susan Bradley when I had that client as a lottery winner, and it is fascinating and really important. So the annual gifting idea that you've brought up is just a nice way to put your toe in the water and get a feel for how are the kids handling it.
I love it. This idea of financial literacy for that next generation is so important to so many people. So if you asked me, if we were having a beer at the end of the day, John, what keeps you awake at night? Okay, I talked about retirement and how I'm going to have purpose in my life when I stop doing what I do. That's something that's on my mind. Running out of money, knock on wood, I'm hopefully, okay on that front. What keeps me awake at night are my two kids. And they're good kids, by the way.
Oh, yeah.
But have I done what is required? Have I done what's available to me to teach them about financial responsibility? You see it all the time, Patti. Wealthy families, God bless their success, but sometimes money does bad things to good people. And it causes bad behaviors, entitlement and lack of motivation and materialism and big egos. And how do we, as financial advocates for our clients, how do we help them instill the right values and the right financial literacy in their children? I think we can do some good work on that front.
I think we can as well. I love the idea of these incentive trusts, giving the kids a sense of the values. A lot of people, we actually meet with the attorneys with our clients, because I think it's important for clients to realize that a will or a trust, it's just a letter. It's a letter from you to the executor or the trustee, describing what you'd like to have happen with this money that you've worked your entire life to accumulate. And you can share your values. You can, talk about that. And, if you don't want to put it actually in the document, you could write a letter and attach it. I just think sometimes a handwritten letter in blue pen from mom and dad, is it like, haunting the kids from the grave? Maybe a little bit, but if it's values oriented and, and is there to teach the kids about the money and the responsibility that has been bestowed on them with the money, it can provide a terrific benefit.
I love that idea. There's we've developed a curriculum on how to help families instill the proper values in their children and the financial responsibilities. A really good book I just finished reading, actually two of them. One is called The Opposite of Spoiled, written by Ron Lieber. He's a columnist for the New York Times.
He's so good.
He is good.
Ron
and it's a cool
phenomenal
title, isn't it? The Opposite of Spoiled.
I got to get this book.
Yeah, it's good. It's good. I'll send it to you. I've got a couple of copies back in my Chicago home office. The second one is called Kids, Wealth, and Consequences, written by Richard Morris. And he suggests that we teach our children a number of really important lessons. Now, the children he's referring to are probably, elementary school children, but I think the concepts apply across the age spectrum. Number one is we have to teach them how to hear no, because too often as parents, of a successful family, we just give them what they want. I'm not sure we're helping them in that process. The second thing we have to teach them is the difference between wants and needs. What is it that you want in life? What is it you need in life? Third, delayed gratification.
How about that?
My
for a
son asked me
concept?
for an
Yeah.
85-inch Samsung 4K OLED TV when he was going to college. What was the answer? No.
Right.
You're not getting the TV. And I said, look, if you come on home and work during the summer, Mom and I will match dollar for dollar everything that you are able to save and put aside for it. And it took him a little bit longer to get there, but he got the TV. And I'd like to think he learned from the experience and he probably appreciated it a lot more than he would have if I had simply given it to him.
You know, it's interesting. I didn't plan on telling you this story, John,
Okay.
but I'd like to share something with you.
All right.
When my kids were little, of course, we were really crazy, and life was just like it was work and it was family, and our idea of going out was going to Kmart, right?
Okay.
So we take the kids to Kmart. We had two rules. Number one, stick like glue, because my kids were always roaming. Especially,
You don't want to lose a kid in a
oh,
Kmart.
and it has happened. It has happened. You know, the blue light special was Patty carries up at the front again, right?
Exactly.
That was number one. But number two was no begging. No begging. And every once in a while, they were kids, right? So they would test the boundaries.
Right.
And they might ask for something. And my response was not, we can't afford it,
Right.
because I heard that growing up.
Of course.
And that made me feel financially insecure.
Yeah, that's not good.
So what my response was, we don't choose to spend our money this way. 6 months from now, you're not going to know what that toy is, where it is, etc.
Right.
I think you're going to thank me when you graduate from college.
I love it.
And so it was beginning that delayed gratification that you referred to.
These are great lessons you're teaching the kids. Here's a similar methodology that I've seen work for other families. Family vacation, not the Kmart shopping trip, but similar idea. So in our family, my wife does all the heavy lifting on the family vacation,
Yeah.
right? And from Wilmette, you're going somewhere for spring break. Of course, everybody does. My wife used to do all the heavy lifting. It was a lot of work. And so finally, when the kids became teenagers, we said, change in rules. You guys own the family vacation this year.
Wow.
And we gave them a number. And they then did the research. Are we going to Bermuda? Are we going to Hawaii? Are we going to Florida?
Wow.
Where are we going on vacation?
Yeah.
You're going to decide where we're going to stay. You're going to decide if we're going to fly coach or first class, or are we going to stay in a Holiday Inn or a Four Seasons? You're going to decide where we're going to eat at night. You are going to make the decisions on budgeting. And our kids learned a couple of, I think, important lessons. Number one is how much work it is to go on vacation. Instead of just showing up with your backpack, you're going to have to do all the work to pull this off, and hopefully you're more appreciative of the opportunity. Number two is you're going to learn the lesson of how expensive a vacation is. I think a lot of kids don't know how costly it is to take a family of four on vacation. And thirdly, you're going to learn how to budget, where you're going to allocate or apportion your decisions in terms of what you want to use or what you want to spend while you're on vacation. So,
I love the way you frame that, allocating capital. Instead of using the word budget. If you've, and everybody who knows me knows I'm not a big budget person.
I hate budgeting.
Yeah, it sounds like we have to
terrible
give
at
up
it.
something we really like a diet, right? I got to give up something that I
Right.
love to eat.
It's
And
not a pleasant experience.
No, I don't want to do that. But allocating capital is very positive.
There you go.
Allocating income is very positive. And so now let's bring it circle back and say it's taxes,
Okay,
right?
yeah.
That's one form of capital that I don't want to pay as much, right? So charitable giving is huge, right? And estate planning is huge. I personally think and worry that people are becoming a little too complacent as it relates to their estate planning.
Okay.
Because one way or the other, we're probably going to get this sunset provision, and that amount that you can leave to the next generation is going to go down when hopefully net worth people's
It's going to go up.
Is going to go up.
What do you think that number, is going to be? I mean, I know it's 12 million today, right? We saw a modest increase due to inflation adjustments for 2022. Where do we, any ideas on what people should be thinking about?
Yeah, I think the low-hanging fruit is just to go back and let everything sunset to prior to what it was in 2017. So we're talking around $6 million.
Okay, per couple.
Per couple.
Okay, got it.
Per person.
Oh, per person. Okay.
That's what I'm thinking. What are you thinking?
We don't know, but we do think it's going down, and maybe there's some sort of an adjustment between now and then that makes it a more modest number. Directionally, we're on the same page.
Interesting.
It's going to be a significant, let me put it this way, it's not going to be more than $12 million.
No way. No way.
I'm willing to bet you anything you want that number is
Yes.
going to be significantly lower.
Yep.
And families that haven't thought about it, families that have chosen. Who the heck wants to talk about estate planning?
I know.
What you're bringing up two of my least favorite subjects: A, my death, and B, the taxes I pay. That doesn't sound like a very pleasant conversation. So I'm hoping or assuming that you found a better way, a more enjoyable or productive way to bring this up with your clients.
You know, the way that I try to frame it, John, is to really think about it in terms of the amount that you can leave to the people that you love.
I like that.
And, you know, when we leave money, you know, when we pay our taxes, we've talked about that that's an important role that we all play. But, you know, the federal government may not allocate that capital the way that you would want to allocate it.
That's good.
Too.
That's good.
So by doing this estate planning, if there are charities that you feel strongly about, you know, I don't know about you, but I always tell people that the tax law is out there to create an incentive for all of us.
For behaviors.
Exactly. It's not to punish us. It's just to encourage us to do things like save for our own retirement instead of becoming dependent on the federal government and Social Security. To, you know, save for our own medical care in the form of HSAs.
To be long-term investors because we're going to give you a lower capital gain rate. It's to incentivize good behaviors that are in your best interests.
Exactly. So, you know, with that in mind, that's fine and dandy. So why don't you take that incentive and think about how you'd like to allocate that capital?
That's good.
And then your kids or the people that you love get the rest. And then they get to do the same thing. So it's all, again, just like you were talking before, it's communicating the values, to communicating what's important to you about your money. Because really, I mean, at the end of the day, it's a stewardship. Most of our clients, and those of you who are watching today, no matter how old you are, and no matter how much money you have, you really worked hard for that. What you have is money that you have after you paid the taxes. And, you know, it's a stewardship over your hopefully very long life, or maybe it's a little bit shorter. And so it's a stewardship to determine what can happen over the rest of your life, and then what do you want to have happen afterwards?
Right.
Because it's you know, we talk about compounding being the eighth wonder of the world, and I think it's really cool. You know, you'll appreciate this, and we're talking about estate planning and taxes and all of that. But I went to a meeting one time. It was at a Forbes or a Barron's or one of the conferences, and I'll never forget this, John. Well, I was sitting in the audience with about 500 CFPs. And the person that was up on the stage was talking about this estate planning, and they asked the question. They said, "I'd like to see, your hands. Raise your hands if you can remember the first names of your grandparents.
Okay.
At least just one of them." And so most of us raised our hands. Great. Now I'd like you to raise your hands if you can remember the names of your great-grandparents. Do you know that nobody raised their hand?
Sure.
And then he said something that has stayed with me ever since. He said, "Isn't it a shame to think that 100 years from now, people aren't even going to remember our names?"
Interesting.
In our own family. And so we talk about this thing called legacy. And we talk about estate planning and taxes and all of that, but it's more than that. It's about legacy. And while we're alive, we get to do things that can create impact on other people's lives. You do it by being here today. You've created so much impact for me, John, in the short time that I've known you. I'm going to be enrolling in a graduate degree program because I learned about it because of you.
Love it.
And hopefully that'll make me a better advisor to the people that I serve.
That's great.
And that's what we do. We get to have impact in the lives of people around us. And taxes, yes, they are important. And we want you to keep more of your own money so that you get to do with it what you want.
I love it. So what you're referring to in these great examples is control, right? In a positive way. Control that I decide where my hard work and efforts, where that goes. Does it go to my family? Does it go to a government program? Does it go to charities I want to support? And I think that's what all of us want. As successful people, we want some control or influence over what happens in our lives and what happens in the lives of others. That's empowering. It's good.
And what we've learned today from you between this podcast and the podcast before, and by the way, as John said, we could be here for hours and hours talking about the tax planning techniques. Some may apply to your situation, others do not. Take what applies to you and throw out the rest. There's a lot out there. And what we learned with the prior podcast in terms of this concept of control, right? And controlling, we can't control markets, we can't control a lot of things, but what we can control is what we do about it.
Yep.
Right? And that's what it's all about, to understand the impact in your lives on a personal level. John, I can't say enough about you and what you've done, and I appreciate your time today. Sure. I appreciate you, Dan Miller, at PIMCO, for bringing somebody of this caliber to my office. It's just incredible, and I'm so grateful to you for tuning in today and listening to us and watching us. I hope it's been helpful. John's favorite four-letter word, HELP. That sings to my heart, right?
Good.
That's what it's all about.
Sure.
Can we make a difference in your life?
Love it.
I hope we've done that for you today. Thank you so much for tuning in, and I hope you have a great day. By the way, if you liked it, go to our website, keyfinancialinc.com. There's a lot of information on our website, almost 100 podcasts on all different types of subjects. We're here to help. We're here to make a difference in your lives, and thank you so much for allowing us to do so. Have a great day.